Hi, traders. Welcome to Market Outlook Trends, Risk Events, and Trade Setups. Brought to you by Vantage Markets. This is a weekly webinar where what's been happening in markets and what is about to happen in the week ahead. Whilst I just let you have a quick look at the disclaimer. I'll just run through some of the just what we're going to look at in the next 30 minutes or so. Bit of a lighter webinar, probably, as less data, actually, obviously, with this US government shutdown. But hopefully, fingers crossed, we do get some sort of agreement with that. And then, yes, we could get some data to preview and review. But otherwise, moving on from the disclaimer, here's what we hope to get through. As I say, next 30 minutes or so, we'll focus on, how markets are trading currently. We'll look at the hopes for that government shutdowns. We'll look at that in a little bit of detail, actually, and just figure out, yes, when we might get some data, actually, and just the impact for currencies and stock markets as well. So we'll look at usual format, then look at global equities and some of the US stock indices as well. So we'll look at those charts. So the S&P 500, the Dow, and the NASDAQ. After that, which will be fairly in depth, actually, as of course that is the big theme for markets at the moment. We'll just check out some of the recent central bank meetings from last week, actually. So the Bank of England and the RBA meeting. And we also have some UK jobs data out this week. So we'll look at that and look at sterling against the dollar, as well as Aussie jobs, actually. So we'll look at Aussie against the dollar as well. And then we'll look at the DXY chart in amongst that, just for your guide. Before then, hopefully we'll have time actually to look at gold, and we'll look at just a few reasons why it's climbing today over 2%, and some of the ideas for the gold drivers actually going forward. Should say, if you do have any questions, please do ask them along the way, or always more than happy to ask any questions about what we're talking about, or what I'm talking about, what you're looking at, trade setups or fundamentals as well. So please do ask any questions in the chat box. More than happy to try and answer them. Okay, markets currently, I've got a couple of charts that I've kept in here, actually. It's interesting that we've had that sell-off last week and some sort of jitters around. Well, we did have concerns around, of course, AI valuations, really, after a few results from last week. The week before, Palantir really set it off, pretty decent results, but a big sell-off in that stock. Just questions around valuations there, and that led to a bigger sell-off in some of the other tech companies, the big tech companies, of course. Losing, I think, around $800 billion actually last week. A pretty bad week, their worst week since April. And of course, the tariff liberation day sell-off. I just sort of left these charts in here just to show you that we are, or how far we moved, pretty obvious to everyone. But yes, the Mag 7 versus the rest of the 493 companies on the S&P 500, and very close to highs there. So in a way, due some sort of correction. Again, that would have to adjust these figures slightly, but you just get the picture with the outperformance of those Mag 7 again versus the rest of the broader market. And then obviously we did have that news not so long ago with NVIDIA topping $5 billion market cap, first company to do so, and heralded for that, of course. But yes, just warning signs that things were slightly overdone. And of course, we've been talking about that in the last few months, and even also on our written pieces in the week ahead, especially just with sort of bubble tendencies around some of the stocks, and just with some of the financing deals as well that we've been looking at, and that sort of circular flywheel of AI capital. I called it in our week ahead, actually, and called it a sort of AI hot potato with, or hot potato with AI capital, I think I called it. And just sort of thoughts around that as well. But yeah, we have seen that correction. But now, of course, with the government shutdown hopes stopping, then we have seen APAC stocks trade higher, of course. That's a government shutdown, as well as improving US-China trade tensions sort of easing. Just on China inflation, actually, over the weekend, that printed above forecasts, although factory gate prices remained in deflation. And then just looking at markets generally in headlines, NVIDIA, Jensen Huang, the CEO, he said they have a very strong demand in Blackwell chips, and he has asked TSMC, the Taiwanese chip maker, for more wafers to meet strong AI demand. So all helping really equities move higher, especially, of course, that hopes of the ending of the US government shutdown. Several Democrats supported Republicans to pass a measure through the procedural vote in a rare Senate session yesterday actually took place. So we've seen European equities move higher. Euro stocks 50 up around 1.6%. And that is after the market closed on Friday. Just on the shutdown then, basically the Senate in the US has taken a key step towards ending it was a record government shutdown, 40-day government shutdown, basically by advancing a bill to fund the government through the 30th of January 2026 and include 3 full-year appropriations measures. The deal, basically brokered with bipartisan support, ensures actually back pay for federal employees and a December vote on extending subsidies, which was a key Democratic demand. The bill now moves to the House, just for your guide, and then to President Trump for approval. It kind of seems actually, and I've been tied up in this actually with my son actually in the US, just the prospect of massive flight delays around Thanksgiving and the delay actually in food aid payments as well. But especially those flight delays, if you've seen any of the sort of charts or the maps of the US and where those flight delays are centering around, they're growing. And with the delay in food aid payments as well, that essentially looks like it prompted a group of moderate Democrats actually to back a proposed compromise bill in the Senate. Of course, that compromise then, that's exactly what it is. So it's far from meeting the full Democratic demands of a delay in the end of Obamacare healthcare subsidies. And Democrats in the House may still reject the compromise. So just watch out for that. And of course, headlines around that. Certainly the next 48 hours in Congress should really tell us whether the initiative can really get pushed forward really and has legs to then see the shutdown. Market impact wise then, it's interesting, sort of markets seem to see short-term relief as global shares, as I've said, have risen on optimism over the progress to end the shutdown. Stock futures, they're up. US stock futures, treasury yields edged higher, and the dollar kind of recovered some of its loss is from last week, although it's pretty flat now, just checking that on the day. But then concerns do mount around, obviously, the economic toll from the shutdown. Certainly, we could see risk on, and that's kind of what we're getting in stocks, at least now. But it's interesting for sort of currencies, whether it plays out for the dollar. Late last week, the greenback was under pressure on job layoffs and rhetoric that could contract in the fourth quarter should the shutdown extend. Of course, now if we don't get that, we still have had the impact over those 40 days. And we had on Friday actually poor US consumer sentiment data, and that was read as dollar negative. So in a way, progress to end the shutdown may be felt more by risk sensitive currencies, and we're seeing the Aussie dollar, certainly that's risen 0.64%. Actually, Kiwi dollar also up 0.3%. So those sort of risk high beta risk sensitive currencies are doing better rather than potentially the dollar. We shall see, but just because we've had, of course, that poor data that we did have last week as well. Otherwise, sort of economic impact wise, I guess the rule of thumb has been typically every week of a shutdown subtracts around 0.1 percentage points from US GDP growth in the quarter in question, with the sum total that lost output then recouped the following month. And so that's the sort of guide economic wise. For employment data wise, this is what we've been trying to check out actually. And when we get data, then that's the other sort of point towards to all of this. The BLS, the Bureau of Labor Statistics, they're likely to be able to release the September jobs report relatively rapidly. If we look at the 2013 shutdown, it took just 3 days, working days after that ended. With the data having already been collected and compiled. So that's potentially is what we'll get. The October jobs report, though, that's somewhat different, really, with no data collection having taken place amid the shutdown. And that means then, well, the BLS will now send out potentially the usual surveys upon reopening. Basically, they'll be asking the population to reflect on employment conditions around 4 weeks ago. So that will certainly no doubt lend concerns about really how accurate the data is likely to be. Same applies then to the November jobs data or the jobs report, essentially, because the data for which is due to be collected this week, and which may also then be delayed depending on when funding is restored. So yeah, a lot of questions still around obviously this optimism, and we'll be watching it closely, of course, with headlines around the passing of these bills, and then also then any hints on when we get data, of course. If we just look at some of the stock market indices now, just for your guide, global equities, they ended lower last week, including on Friday. MSCI World, that was down roughly 1.5% on the week. As I say, tech took a hit, really. Defensive sectors outperformed, and then cyclical growth lagged. As I said, valuation concerns resurfaced in really the media, and we had some CEOs of Goldman Sachs, I think, and Morgan Stanley saying about a correction, although 15% correction was healthy, I think is what they said, before then a continued uptrend. Interestingly, we did get quite a strong daily positive correlation between equities and yields, basically a negative correlation between equities and bonds. That pattern kind of reflect that mixed US labor market data we did actually get. We got upbeat ADP employment figures one day, but then they were followed by weaker challenger job cuts the next day. So that's what we got for global equities. If I just show you the charts, first of all, and US indices, really, we'll look at. So this is the S&P 500. This is cash, actually, not futures. Futures just up around 1%, just under 1%. So hopefully, if I just expand it slightly. So we've got this channel, which we kind of moved out of on Friday, but then that bid towards the close, actually, I think, sees us really just inside that channel. If you can see that sort of series of higher highs, higher lows, and then the blue line is actually the 50-day moving average. Let's just take the Keltner channels off. That's better. So the blue line is a 50-day moving average. That's at 66.70. So we tap that, off a decent support, actually, that you can see, as well as a minor fib level, 66.48 of the move from sort of May up to the record highs. So that minor 23.6 fib level at 66.48, 50-day moving average at 66.70. And so we're just possibly inside this. If then I show you the futures, actually, so you can just see that tap of the blue line, the 50-day, and then we're up back into this long-term bull channel. That looks fairly obvious there, I think. And if we then look at the NASDAQ, similar chart, strong bull channel, though we haven't drawn that channel in. and then futures are up 1.5% actually. So again, tap the blue line, the 50-day moving average. That's at 24,709, and then you've got the 23.6 fib level of the similar move. That's at 24,867, and we're above that. And if I just show you futures, and you can just see, we're just back into this channel really, with sort of bulls hoping for 26,000 and above really. The Dow, just for your guide, those futures only up less than 0.5% actually. We didn't quite tap the 50-day moving average. That's at 46,391, with the all-time highs just above 48,000. Interesting really. You kind of think, I know I've mentioned the sort of worries about AI valuations, of course, and the financing deals, a sort of circular financing wheel. But macro fundamentals kind of remain relatively solid, although we saw some creaks and some cracks really in the labor market last week. But earnings results as well, fairly solid across what we've seen so far. Then we've had, of course, those latest developments in the US-China trade relations have been relatively constructive as well. And that kind of says, in a way, we won't see an increased probability of a market correction. If anything, you kind of got the combination of resilient data and market dynamics, strengthening confidence that equity markets are likely to move higher in the near term. So that's a sort of broader picture, and potentially with this momentum, if we do get the end of the shutdown, then potentially we're looking at those record highs again in stocks. Okay, moving on from that. Let me just grab next couple of slides. Let's move on to events then. We had the RBA and the Bank of England meetings. Just on the Bank of England then, they held rates as expected at 4%. The vote, though, was more dovish than expected, 5 to 4 versus probably 7 to 2 or 6 to 3 were expectations. So dissent, that came from Dinger as usual, Taylor as usual, Ramsden, somewhat expected, and then Breeden as well. That was unexpected. Dissent has led to the decision being characterized really as a dovish one, so a dovish hold, if you like. And that did spark some sterling pressure and also government bond gilt upside. A statement at the Bank of England that saw a slight change to forward guidance, though only a marginal tweak, really. There was significant focus on inflation in the report again. A large portion of the MPC, in particular Governor Bailey, emphasized that the welcome September print was actually just one series and they needed more data, which is fair enough. And that point was emphasized by only a minor tweak to the CPI forecasts. Interestingly, in terms of market pricing, Governor Bailey described it as a fair description. And pre-BOE, this pointed to 2 more rate cuts and around a 1 in 4 chance of a third, with the end rate, the terminal rate, if you like, just under 3.5%. We're 4% at the moment. And pricing hasn't really changed. In the press conference, Bailey stuck to the script, really doubling down on the inflation focus and really outlining that he has no view on neutral, but sees current policy as still being restrictive. Overall, then, no major changes to the outlook after the Bank of England, with essentially a December cut still the base case for most. I think around 65% chance of that markets see. But also then very much dependent on CPI data and also then the 26th of November budget, which will, and is it getting huge focus in the UK. If you're based in the UK, a lot of headlines around this virtually every day on what the Chancellor may do. Bank of England, though, the fight of all votes, really, that vote split probably makes a December cut really quite likely. The decision will hinge probably on Bailey as the sort of swing vote. as really you kind of think those in favor of and against seem pretty entrenched in their positions. That means, as I say, CPI data will be important. So we get October CPI on November 19. And then, as I said, the budget is out on the Chancellor announcing that on November 26th. And then we get the November inflation print for the UK on December 17. And that is then the day before the Bank of England on December 18. So just for your guide, some data points to look out for cable and sterling generally, of course. Those are, just a chart there on, interest rates at the moment, potentially peaks inflation that we talked about last week, actually. So that is encouraging for the doves and not actually hitting 4%, 3.8%. And potentially if services inflation and wage growth is also easing and cooling, then likely we will get a December rate cut. As I say, around 65% chance markets giving of that happening on the 18th of December. Moving on from that, we also had, there's the peak inflation chart, sorry. And just a red line, the headline number 3.8, services is important, includes wages, of course, at 4.7, so still elevated, but coming down potentially. And then core CPI 3.6%. Again, just highlighting these figures, obviously way above the 2% inflation target for the Bank of England, but hopefully coming down. Okay, moving on from UK to Australia and the RBA. They left policy rates unchanged at 3.6%, widely expected after the recent higher than expected inflation data. It was all about that, really. The RBA did take notice of the trimmed mean in accelerating to 1% Q on Q and 3% year on year in the September quarter. That certainly was materially higher than expected. Headline, that also increased above the 2 to 3% inflation target range. And it's interesting, actually, even as the RBA assesses that the part of the rise in the underlying inflation is due to temporary factors, their new forecast now sees inflation rising above 3% in the coming quarters before settling at around, I think it's 2.6% in 2027. So a scenario based on one more rate cut in 2026. That's inflation on activity. The RBA indicated that the pickup in demand continues and that the housing market strengthens further. Labour market conditions were assessed as being tight, even as actually the unemployment rate rose from 4.3 to 4.5%. And then on monetary policy stance, the RBA said there are uncertainties regarding the assessment that monetary policy remains a little restrictive. Given recent evidence of more persistent inflation, though, the board basically judged it was appropriate to remain cautious, updating its view of the outlook as the data evolves. Modest reaction really to this. Government yields on Australian government bonds, 3-year government yields, they rose marginally at the time. And money markets, they still see around a 75% chance of one more rate cut by the middle of next year. That's what is the current situation with the RBA. As I say, we do get Aussie jobs data as well. That comes out this week on Wednesday. Just for your guide, moving on to sort of next week. Expectations are for headline jobs to print around 20,000, I think, just stronger than the prior 15,000. Unemployment forecast to move 1/10 lower, actually, to 4.4%. The September report for your guide, employment change was, as I say, 14,000 actually, and the participation rate was at 67%, while unemployment was at 4.5%. Employment growth has been easing, though, more broadly, as economists cite a sort of rebalancing across industries that reflects kind of softer momentum in the sort of job-intensive care economy versus a sort of patchy recovery in the market sector. That's Aussie jobs. If we just pull up then Aussie against the dollar, Aussie chart, just bear with me. Pretty strong today, as I said, up 0.7% pretty much on the day with this risk on sort of mindset. This is Aussie dollar, been tracking fairly sideways, really, hasn't it? You can see between sort of 64, 66 with a couple of breaks to the upside. We've got the 200-day moving average, that black line, that's the 64.49. Pretty decent support, looks like. But then we've got, yeah, the 50-day moving average above, that's the 65.58. If we can break this, then sort of 66 looks like a fairly decent resistance level. And then you've got that high from mid-September at 67.07. Otherwise, this week we do get, as I said, UK jobs data and GDP data. Jobs data relatively important, obviously, for wage growth figures. Unemployment, that's expected to tick up actually to 4.9 from 4.8%. And then wages, they're seen, well, potentially moderating, bonuses from 4.7 to 4.6%. And then the 3-month figure, that's important for the MPC. That's also expected to moderate to potentially around sort of 4.4, 4.3%, which would be much cooler than the Bank of England's forecast, actually at 4.7%. As I said, though, there is a lot of focus on inflation generally, but certainly wage data will feed into that and then could obviously provide some early comfort, to Governor Bailey. But then, as I say, we will be watching the next 2 CPI prints ahead of, November budget as well, of course, before then that mid-December Bank of England announcement. We just got here cable then. We have had a decent sell-off, actually, with those expectations of a Bank of England rate cut rising. And then we found support just above 130. We've got the black line, the 200-day moving average above at 132.65. If I just pull it back, actually, you can just see we're just above this 38.2, retrace 40. That is basically this year's rally, actually. So the 38.2 major retrace level, which capped the downside there, you can see in August. That's, as I say, 131.40, upside 132.60. Otherwise, then minor fib level plus the 50-day moving average around 133, 85, 86 there. So interesting levels for sterling as we go into a pretty key part of the year, really, with the budget and then obviously the final MPC meeting. Okay, we'll also look at, I said we'd look at the dollar index chart, and I've gone through sort of permutations really for the dollar potentially. If we do get this shutdown, may not benefit as much as some of those higher beta currencies, as I said, like the Aussie, like the Kiwi. So dollar index chart, you can just see, yeah, we broke above a couple of levels, that 23.6 fib level of this year's down move, actually. That's at 99.51. Then we've also got a level at 99.57, which is a swing low from 2023. I'll just pull it back here. I always show you that, which is here. So pretty big level there. And we got above it, but didn't get above the 200-day moving average, which is at 125, and then we turned lower. That 125 does correspond with those highs from August as well. So decent resistance around there. If we do break down then through the sort of 99.57 area, then potentially, yeah, the 50-day moving average will be a goal for dollar bears, really. That's a 98.42 on the dollar index chart. Just quickly, let's look at euro dollar. If you sort of mirror image of the dollar index, because the dollar index has a big weighting of the euro, 56% or so. So there you can just see, long-term fib level at 150. just above that now, and probably I should take these minor fib levels out, but I was just trying to get then the next fib levels, shorter term fib levels in here, 61.8 of this move higher from August to September. That's around 115.92. And then midpoint at 116.55, along with the 50-day moving average at 116.64, that blue line. Okay, that's euro dollar. Let's get into gold then as well. You can just see we're having a really decent day today, up around nearly 2.4% now. Yeah, really interesting because, they've started the week well. Silver as well, pretty decent conviction, extending Friday's rebound actually, and signaling really that investors remain willing to add exposure to precious metals despite a small rise in bond yields that we have seen recently. I think the macro backdrop is interesting. I've touched upon that from last week. Unusually mixed, really, with, in some of that labor market data that we saw at the end of last week, challenger job cuts, pretty poor, really. And then, as well as this sort of easing or cooling in some of that data, then potentially we could get a shift of the market focus back to the deteriorating US fiscal outlook. If we think about that, then yes, the US is already running a deficit. I was just checking the number, close to 6% of GDP at a time when the economy is showing these creaking signs of fatigue, really. As I said, consumer sentiment last week, that University of Michigan survey, that weakened again. And then forward-looking components of activity are softening. We also had this announcement by by President Trump, of a $2,000 tariff dividend potentially being distributed to low-income households. That is effectively funded by tariff proceeds and additional borrowing, and that really doesn't help the sort of fiscal picture, really. And sort of doesn't sit comfortably with that idea. Of course, injecting more cash into an economy, wrestling with still sticky inflation, slowing demand, elevated rate risks, deepening really, rather than any sort of resolution. The fiscal picture sort of imbalances more broadly. Interesting idea there, and potentially that is why gold is jumping quite high and finding a strong bid today. I know there's, people have mentioned the dollar, but that's fairly stable, although is coming off slightly. But that has been, the dollar has been fairly decent over the last couple of weeks, at least, as I showed you. But then this idea that potentially the market shifts back to unease, really, over fiscal sustainability, really. That sort of deteriorating US fiscal outlook is a potential driver, as well as then gold drivers in general, catalysts that we have seen, of course, for this incredible rally. Central bank buying, underpinning support, really. And then all around the sort of de-dollarization issue, which for us is a sort of long-term, broader underpinning of support for gold. So you can just see then we've got some fib levels, short-term fib levels. But yeah, if I just highlight the 50-day moving average, that's at 38.90. And then sort of longer-term fib levels, don't want to confuse you too much. After, a push higher really from September upwards, which I'm just looking at. We've just gone through sort of 38.2 retrace. That's at 40.44. So next level really around 41.66, 41.73, a couple of fib levels there. And then, of course, the all-time highs at 43.81. But it does look like bullish momentum has picked up pretty well after finding this base just below 4,000, which makes sense, really. And yeah, then near term sort of initial resistance potentially around sort of 41.66, 41.73. Okay, I think we'll wrap it up there. I don't see any questions, so I really hope that has been clear to you guys. I really do appreciate you being on the call as always. It's really great having a lot of people who come back and listen every week. So really do appreciate that. Please do follow us on social media. And also, I always say I do put out a daily commentary after the US close around the dollar, US stock markets, look at the day ahead. If there's interesting data coming up or something interesting happening, and also a chart of the day as well. Okay, take care out there, and we will speak to you hopefully the same time next week.